So I am long gold. I've talked about this over and over and over, but for bond auctions today, bond auctions going well would be good for gold. Why? Because bond auction demand would say, well, people are jumping into bonds now because they think the economy will continue to slow and that jobs could come down. And yesterday we heard from Jerome Powell something really important. I want to kind of just do some note taking with you guys for a minute on what we saw from Jerome Powell said. So here's what he said that kind of stuck out to me. He said equal risk to jobs and inflation. He said significant progress on inflation. Would like to see more progress before making a cut. Okay. Whoops. So this is kind of what we're working with from yesterday from Jerome Powell. So JP said there's an equal risk between the two of them, which is a change. This was not the case a year ago. A year ago, it was inflation is our problem. And this is what we're going to focus mostly on. We have changed. Times have changed. And Jerome Powell stated very clearly yesterday that he thinks there is equal risk to the jobs part of their mandate as well as the inflation part of their mandate. Remember that the Federal Reserve has two objectives, at least on paper. This is what they say they do. They say that they want to keep maximum employment and stable prices. They say that over and over and over. But it's all in the antics. It's all in the little things when you listen to Jerome Powell speak. And the big one that stuck out to a lot of investors yesterday was there is an equal risk. That is a change in the narrative. He also pointed to the 2.6 PCE percent number year over year. So year over year, he said, well, PCE is at 2.6. And at some point, you got to start saying, well, look, inflation at 2.6 for PCE, is inflation still an issue? Yes, the CPI is still in the threes. But you can't ignore, and the Fed is certainly not ignoring, or Powell is certainly not ignoring the idea, well, look, unemployment rate is now steadily on the rise. Now you might say, well, Nick, 4.1% is historically a fantastically low unemployment number. But remember that when it comes to this stuff, a moving train is really hard to stop. So what the Fed wants to avoid, I want to paint a picture here, and because I really want to kind of highlight how important this chart is now. I want to reiterate what we're looking at here. When it came to inflation in the last few years, the Fed was most terrified by inflation when it was rising, okay? So when inflation was doing this, the Fed, all red flags said, this is our number one priority, get inflation to stop rising. Okay, so I know that we're not at 2% for inflation, but we have to think about something. This is what got everyone at the Fed and everyone on Wall Street freaked out, was inflation. I for inflation, okay? Inflation was rising dramatically. That's what got the Fed to say, hikes, hikes, hikes. We'll worry about everything else later, but this inflation cannot happen, right? Inflation is still high. I'm not saying, and prices, just so you know, unfortunately, will never go down. I don't think prices will go down, and you don't actually want them to go down. If prices in the store are going down, everyone's lost their job, and it's another 2008. That was the last time we saw deflation, right? True prices coming down on a overall scale was a terrible, terrible time. So you don't want that to actually happen. You want demand for products and stuff to still rise. You just want it to rise slower. Have we accomplished that? Kind of. Are we at 2% inflation? No, we're not. We're at like 3.3 or something like that on the CPI, or is it? is it 3.4? I'm blanking. Someone tell me, what is inflation at? Because my chart broke for today. I don't know why. So I'm looking at this and I'm saying, okay, look, here's the dilemma now. Now you have unemployment rising. It's no question why Jerome Powell said equal now, because unemployment rate is rising, and technically we've seen some, albeit very mild, inflation progress. We've seen some progress in inflation, but unemployment is starting to move higher. And when that starts, you have to watch that, because when it starts to move higher, that can very quickly accelerate. Does that make sense? Are we on the same page with this?
Market analysis, free trading courses, edge finder data, and special offers. What do these things all have in common? They're all available for you right now inside of our free Discord. You can click the link down in the description below to join the free Discord today and get access to all of this and more. Stay up to date with all the latest trading information and A1 content. And if you want to upgrade to our Gold VIP Discord that features every single trade that Trader Nick and our other professional analysts take, you can find the links for that in the description as well. So don't wait, go check out the free Discord today.
So I'll tell you where I am positioned. That is what I like to do, is, kind of just walk through like my current trades, my current things that I'm looking at in the market, potentially adding, subtracting, new trades, etc. The return of Powell, he was here yesterday, he's back again today. Should be interesting to see what he has to say. I saw you commented something, was it about the Bank of England or something on the chat here? Yeah. What are you looking at today?
So I'm not necessarily trading those comments. I was looking for BOE pill to be a bit more dovish. Pound is, for me personally, it's a little strong compared to what I was anticipating for this currency. So I was hoping he was going to come out today and just lean a little bit more dovish than he is. So I'm staying out. But there were people asking in the comments about, why is the pound going super strong right now? And so I just jumped in there and let everybody know that it was from these comments here, which I think it was this one specifically. Services price inflation and wage growth continue to point to an uncomfortable strength in underlying inflation dynamics. So still some concern about inflation out of the Bank of England, and I'm not willing to trade it higher off of that, but the market obviously is taking it up from there.
Gotcha. Yeah, and as you mentioned, the pound is really making a push up to this this key level onto daily. This is the all-time, or not all-time, the 2024 closing high, right around 1.2850. So off of a daily chart level, we're flirting with here. We're testing out a really key spot on this chart to see, if it's going to break or if it's going to kind of reject. Yesterday, you had some pretty sharp rejection from this level. But I guess,
Right.
We'll have to wait and see on a daily chart perspective, like where this thing is going to want to close. Like, are we going to close with a long wick on the top again today? Or are we going to close above this level, which could signal, buyers are really strong here?
Yeah, it would. It's definitely at a very pivotal point here. I think, like I said, I'm pretty dovish on the pound. Overall, not just because we're at these highs, but some of the underlying economics going on with England right now have me relatively dovish, and I don't really see any reason for the strength that we've gotten over the last couple weeks. It's really, it's not making much sense to me on a fundamental standpoint, other than maybe the services price inflation and wage growth. Other than that, everything else leans kind of dovish, in my opinion.
Yeah, it's a tricky one, because it's like you have, if you look at, let's try this out, Euro GBP, take a look at the Euro against the pound. Yeah, there's a lot of pound strength here against not just the US dollar. Here's the pound yen. I mean, look at that chart. My goodness, that has been look at how regimented that upward trend has been. That is really, really crazy. If you take a look at pound Aussie dollar, it's a little bit more mixed because the Australian dollar has been strong. But what about pound Kiwi? Look at that. I mean, pound pairs definitely seeing a big punch to the upside here today. I don't really know what's going on either. I don't follow it nearly as close as I do, U.S. economic data. But I think partially, most currencies are seeing a little bit of a give back with the weaker dollar recently. But, the pound seems to be really strong, even relative to its other peers, as we just walked through. So I don't know, kind of an interesting one to watch that. Did you have any thoughts, Nick, on the dollar here recently? I know Powell yesterday he came out pretty dovish. He came out kind of swinging, saying, now unemployment is equally as important to them to watch as inflation. That was one of the big takeaways from yesterday's hearing. Did you have any thoughts on the dollar right now?
Oh yeah. So for me, I'm seeing Powell yesterday mostly being data dependent. Let's see, let me pull this up real quick for you. So in my private community yesterday, I sent them this statement that when Powell presented yesterday, he's also presenting today. The original testimony, as you probably know, is not going to change, right? So this, I always go to some of the last paragraphs in some of these things, a lot of these statements from either Powell or just the Fed in general, to try to find their forward guidance. I tend to find their forward guidance is in the last 3 to 5 paragraphs somewhere. So I sent this to the group. We continue to make decisions meeting by meeting. We know that reducing policy restraint too soon or too much could stall or even reverse the progress we have seen on inflation. So that's kind of hawkish. They don't want to reduce it too soon. But then you skip another sentence here and you go, reducing policy restraint too late or too little could unduly weaken economic activity and employment. So there's dovish. In considering adjustments to the target range for the federal funds rate, the committee will continue its practice of carefully assessing incoming data and their implications for the evolving outlook. So going into this meeting, I kind of had an idea, or I figured that we were going to be data dependent from Jerome Powell. We haven't gotten too much data that would, I think, push him to the point where he would go, yeah, we're highly considering rate cuts moving forward. It's, it sort of going into it. Like I said, my idea was they're going to kick the can down the road a little bit. He's going to say, we're waiting for more data. We need more inflation data. And that's, not just beyond his testimony. In his Q&A, he reiterated a bunch of statements about waiting for inflation data. Inflation remains above 2% goal. I have some of these highlighted, but not all of them. Let's see. So some of the things he said, well aware that risks are two-sided. Job creation is narrowing in the economy, so there's some weakening in the labor market. We need good inflation data to cut rates. He said that. The last couple of readings show labor market has cooled considerably. We're keeping a close eye on labor market. If we see unexpected weakening, we would respond. Now, he's been saying that since about April. In April, he started mentioning something that was really key for us, the way that I trade with my private group. We trade the data releases. Mm-hmm. So typically, under normal circumstances, we would trade a strong labor data print with dollar upside. But in April, he specifically said continued strength in the labor market would not be a reason for us to adjust monetary policy, right? Okay, sure. So if we get strong labor data, monetary policy isn't affected. I can't have a definable edge in my trades that way. But he then continued on the same foot to say, if we get significant weakening in the labor market, that would be a signal. His words were, that would be a signal for us.
Yeah.
So since April, we've been taking, anytime we've gotten weak labor data, we've been taking dollar downside. But we haven't been trading the same way with strong labor data. Now, I'm interested to see how strong labor data will affect us moving forward, because we are starting to see some downside in the dollar over the last, since the beginning of July. We've started to kind of head to the downside. So sort of starting to get that that dollar weakness that I've been waiting on for forever. And Jay Powell, I would say he was data dependent, but leaned dovish. He said rate hikes are unlikely, right? Let me see if I have that written down. So I don't want to misquote him, but I believe his exact words were, we don't take anything off the table. I'm paraphrasing, not exact words, I should say. We're not taking anything off the table, but the next move is most likely not a hike.
Yeah, right. And that's the thing is, I think, you look at what he said yesterday in terms of a redirecting the dual mandate kind of concept of like, it's not just about the inflation side, it's also about the labor side. I mean, that could be taken pretty dovish. I think that was the takeaway. Like you're saying, it was more on the dovish side. It seemed, he leaned into the 2.6% inflation reading on PCE. And I think that, his mention of substantial progress on inflation over the last year, I think people are happy to hear that. The next battleground, I think, though, and when you talk about the dollar index, you talk about dollar strength or weakness, is this labor data and whether or not it is going to continue to accelerate. And if we see, we're in July right now. If we go into September, and that's when the first real debate for a rate cut seems to be, is like, are we going to get a rate cut in September? Well, between now and then, the data is going to be so important, because if we get 4.2, 4.3, you're going to start seeing increased worries about the other side falling apart, right? Inflation is one side. The other side is the labor data. And if that labor data, which has been trending higher, continues to be, and unemployment rate continues to trend higher, which is not a good thing. If that persists, I think the Fed will lean more and more weighting to that side of the mandate. I was making the point earlier in the live stream that, when inflation was rocketing higher, all eyes, all attention of the Fed went to, let's get inflation under control. And so if you get the other side of the mandate, even if inflation is not at 2% or seriously trending lower, if you see unemployment rates start really accelerating, that also could get their attention. And he's made that point himself. So it will be interesting to see. I mean, we've got inflation this week. We've got CPI reports and PPI reports coming out on Thursday and Friday, both of which will be very important to the market, whether or not we're going to get those September rate cuts or if we're going to push them back. But as you've mentioned, what's important that he mentioned was the next move is likely a cut, not a hike. And that, I think for a lot of the market, is good enough. Like a lot of the stock market just said, okay, next move is still a cut. Who cares? We're still going higher. Don't know when it's going to be, but businesses can kind of look forward to cuts, as long as you don't get the other side falling apart, as long as you don't get unemployment and the consumer hurting much longer. But I think that the last thing I'll say too, Nick, is that there's some areas of the economy that are more sensitive or less sensitive to when we get those cuts. We need to start for like restaurants and consumer discretionary companies and things like that. They need to see rate cuts sooner, because the consumer is feeling the pain of higher prices. So they need to see rate cuts sooner so we can start seeing, some of that tension relieved for them. But then you have companies like Nvidia who really don't care what interest rates are doing. They really don't seem to be impacted by it. You know what I mean?
Right. Absolutely. I'll say on the unemployment rate, what's interesting about this last print, we got 4.1, I believe, correct?
Yes. One.
So the interesting thing about that, if I can pull this back up. So this is the summary of economic projections that was released in June. Year-end unemployment projection was 4.0 from the Fed.
Yep.
So we have already surpassed
It's a good point.
their year-end projection. And if we hit 4.2 on one of these, upcoming prints before September, I mean, you're talking about their 18-month projection here. They're talking about year-end 2025 being at 4.2. If we hit that now,
Yep. That's a good point.
that I think the markets are going to start pricing in significant dollar weakness off of that.
Because that's a surprise to their forecast. That's a good point. Because if they're surprising themselves now, they might, surprise is more urgent than something that's kind of seeing progress. Like inflation, even if it's mild and slow progress, at least they're seeing progress in it. But if they see a surprise in unemployment and a trend higher forming, that is perhaps arguably becoming more and more urgent each time.
Did you know we do a live trading show Monday through Friday with guests from all over the world? To get notified when we go live, click the bell button next to the subscribe button or check in at 9:30 a.m. Eastern Time. We have helpful, free content in the description below and on our website, a1trading.com. Thanks for watching today's video, and we'll see you tomorrow.